Silver has always been considered a quiet metal. It does not move like Bitcoin. It does not attract headlines like gold. For decades, silver stayed in the background, quietly powering industries, electronics, and global trade. But something unusual is happening now. For the first time in modern market history, silver prices are showing a deep and persistent fracture between East and West. In China, silver prices have surged to levels that shock even veteran traders. Meanwhile, in the United States, prices remain significantly lower. This is not a one-day anomaly. This is not a data error. This is not a temporary spike. This is a structural imbalance. In a globalized world, commodities are supposed to have one price. Oil, copper, wheat, and silver are traded across borders every second. When price differences appear, they usually disappear almost instantly because traders exploit the gap. That mechanism is now failing. Silver is exposing a truth many people are not ready to hear. The global market is no longer a single unified system. It is slowly splitting into separate realities. One reality is based on paper contracts, financial engineering, and leverage. The other reality is based on physical demand, real delivery, and industrial necessity. And silver is caught in the middle. To understand why this matters, we must understand how prices are supposed to work. Markets are built on trust. Traders trust that prices represent real value. Investors trust that supply and demand will balance themselves. Governments trust that markets will distribute resources efficiently. Arbitrage is the foundation of this trust. When silver trades cheaper in one country and more expensive in another, traders buy low and sell high. This process forces prices to converge. It is automatic. It is ruthless. It leaves no room for large, lasting gaps. This is why a persistent $8 to $10 difference in silver prices is alarming. It tells us that traders are unable or unwilling to perform arbitrage. This raises a disturbing question. What happens when price discovery stops reflecting physical reality? In Western markets, silver pricing is dominated by futures exchanges. These markets were designed for hedging and speculation, not for delivering metal to factories. The majority of contracts expire without physical settlement. In simple terms, most silver traded in the West never exists in physical form at the moment of trade. This system works perfectly until physical demand overwhelms paper supply. China operates differently. Chinese silver markets are tightly connected to manufacturing, energy infrastructure, and export industries. Silver is not just an investment there. It is a production input. When Chinese buyers pay a higher price, it is because they need the metal now, not next quarter. This difference creates two prices for the same metal. One price reflects confidence. And necessity always wins in the long run. As this price gap widens, many people assume something is wrong with the data. Some believe Chinese prices are manipulated. Others believe Western prices are artificially suppressed. The truth is more complex and more dangerous. The silver market is not broken because of fraud. It is strained because of reality. Silver is no longer just a precious metal. It has quietly become a strategic industrial resource. Modern civilization depends on it far more than most people realize. Solar panels, electric vehicles, medical devices, smartphones, military electronics, data centers, all require silver. Unlike gold, silver is consumed. Once it is used in industry, much of it is never recovered. For decades, global supply was sufficient. Mining output, recycling, and inventories kept markets stable. But demand has changed faster than supply can adapt. China sits at the center of this shift. China is the world's manufacturing engine. When its factories accelerate, they absorb enormous quantities of raw materials. When China pays a premium for silver, it is not speculation. It is survival. Western markets, on the other hand, still treat silver primarily as a financial asset. Price discovery happens through leveraged contracts, algorithms, and speculative flows. These prices respond quickly to interest rates, dollar strength, and investor sentiment, but slowly to physical shortages. This creates a dangerous illusion. Paper markets suggest abundance. Physical markets signal scarcity. As long as physical silver can be sourced cheaply somewhere else, this illusion holds. But once inventories tighten globally, the illusion collapses. The current price gap may be the first visible crack. Now we arrive at the most uncomfortable question. If arbitrage is not closing the gap, who is supposed to fix it? The answer used to be simple: traders, banks, and global institutions. But their role has changed. Over the past decade, financial markets have become faster, more leveraged, and more disconnected from physical reality. High-frequency trading firms do not move metal. Hedge funds do not ship silver bars across oceans. Banks increasingly avoid holding physical commodities due to regulatory risk. This leaves a vacuum. When price gaps appear, there are fewer players willing to step in and absorb the risk. Moving physical silver requires capital, time, storage, insurance, and exposure to political uncertainty. At the same time, governments are becoming more protective of resources. Export controls, tariffs, and national stockpiles are no longer rare. Strategic metals are being treated like energy and food, not free market commodities. This slows arbitrage even further. The result is a market that looks efficient on screens but behaves inefficiently in reality. Price discovery becomes fragmented. Regional premiums grow. Trust erodes. This is how markets behave under stress before major repricing events. Silver may not explode overnight, but when it moves, it will not move smoothly. It will gap, spike, pause, and shock participants who relied on old assumptions. The biggest risk is not volatility. The biggest risk is believing the old rules still apply. What we are witnessing now is not just a price anomaly. It is a shift in how value is discovered in a world that is changing faster than its financial systems can adapt. For decades, investors were trained to trust screens. Prices on exchanges were treated as truth. If something was cheap on paper, it was assumed to be cheap in reality. If supply was listed as available, it was assumed to be accessible. This belief worked in a world where supply chains were stable, geopolitics were predictable, and markets were deeply liquid. That world no longer exists. Silver is exposing the gap between perception and reality. When a metal trades significantly higher in one region and stays there, it is not sending a trading signal. It is sending a warning. The warning is simple. Physical demand is starting to dominate financial narratives. China is not paying higher prices because it wants to speculate. It is paying higher prices because it cannot afford delays. Its industries require certainty. Production lines cannot stop because futures contracts look cheap in another country. When silver is needed, price becomes secondary to availability. This is how commodities behave when they transition from surplus to strategic importance. In the past, silver was abundant enough that inefficiencies did not matter. Inventories were deep. Recycling filled gaps. Mines kept up with demand. But today, silver is being pulled in too many directions at once. Energy transition alone has transformed silver demand. Solar power is not optional anymore. It is policy. It is infrastructure. It is national strategy. Every solar panel requires silver. Electric vehicles require silver. Power grids require silver. Military technology requires silver. This demand is not cyclical. It is structural. At the same time, silver supply is stubbornly slow. New mines take years, sometimes decades, to develop. Environmental regulations are stricter. Ore grades are declining. Recycling cannot scale fast enough to offset industrial consumption. This imbalance creates pressure that does not immediately show up on trading screens. Paper markets can absorb pressure through leverage. They can create the illusion of supply by multiplying contracts. But physical markets cannot do this. A factory either receives silver or it does not. This is why the divergence matters. If physical silver continues to command higher prices in manufacturing hubs, Western prices will eventually have to respond, not because of speculation, but because metal will flow toward the highest urgency, not the lowest price. At that point, the adjustment will not be gradual. Markets that rely on confidence collapse suddenly when confidence breaks. This is how repricing events happen, not with a warning bell, but with silence, followed by movement. Many investors assume that if silver was truly scarce, prices would already be exploding everywhere. That assumption ignores how modern markets suppress signals until they can no longer do so. Financial systems are designed to delay pain, not eliminate it. They smooth volatility, they spread risk, they postpone reckoning. But when physical constraints assert themselves, delay turns into acceleration. Silver does not need hype to move. It only needs a delivery failure, a supply disruption, or a sudden surge in industrial demand that cannot be deferred. When that happens, paper prices will chase physical reality, not the other way around. The most dangerous position in such an environment is complacency. Believing that arbitrage will always fix everything is a form of complacency. Assuming that global markets are perfectly efficient is a form of complacency. Trusting that past behavior guarantees future stability is complacency disguised as experience. History shows that commodities reprice violently when systems underestimate scarcity. Oil did it. Natural gas did it. Rare earth metals did it. Food commodities have done it repeatedly. Silver has simply been quieter until now. The China premium is not a promise of profit. It is a signal of stress, a stress that is currently contained geographically but not permanently. As global trade becomes more fragmented, regional pricing will matter more. Supply chains will shorten. Strategic stockpiles will grow. Governments will prioritize domestic needs over market efficiency. In that world, the idea of one global price becomes weaker. Silver could be one of the first metals to fully enter this new reality. Not because it is rare, but because it is essential. This does not mean silver will move in a straight line. Volatility will increase, pullbacks will be sharp, confidence will swing, but the underlying pressure will remain as long as physical demand outruns supply. Those who understand this shift early will not panic when prices fluctuate. They will understand that noise is part of transition. Those who ignore it will be forced to react later under worse conditions. Markets do not reward certainty, they reward preparation. Silver's message is not about tomorrow's price. It is about how the rules of valuation are changing. It is about the return of physical reality in a financialized world. The question is no longer whether arbitrage is dead. The real question is how many other markets are still pretending it is alive. And silver may only be the beginning.